Equity markets hitting record highs today in Canada and the US. Let's get more from Brent Joyce, Chief Investment Strategist at BMO Private Wealth. Brent, great to see you again.
Good afternoon. Great to be here.
You say just the staying power of the markets has been impressive this year, given the tariff to and fro.
Yeah, climbing the wall of worry like nothing we've ever seen. Best 3 months, one of the best 3 months in the last 25 years for the S&P 500 off of those lows back in April. We're looking at the list of things that could go wrong, and it's pretty well known, right? Tariff threats get, rebooted, stagflation, government spending, higher bond yields, rising unemployment, like all those. But the list of things that could go right is longer. Productivity, balance sheets are strong on corporations, resilient economic growth, adaptability on the part of consumers and businesses, deregulation, fiscal spending boost in Europe, Canada, China, a little bit in the US. We've still got the AI story. We've still got all this data centers that need to be built, all that sort of stuff. Markets over the past couple of weeks have been focusing on the list of things that can go right. More and more of those things need to be checked off now that we're getting to valuations that have priced in a fair amount of good news.
Yeah, there is a lot of optimism built in right now.
Yeah. I think we're going to start to think about next year. People have sort of written off the next 6-8 weeks. We think about three sort of Ds, right? Are things disrupted? Data from all of the noise. Are they delayed, like inflation from tariffs? Or are they just downright not going to happen? Right? And so there's an argument in there for the bears, the bulls. It's a lot of wait and see through the next number of weeks. We're trying to focus on what does 8 months from now look like, 18 months from now look like. If we have some of those negatives, they provide feedback that we've already seen so far this year, curbs behaviors, calibrates policy. The positives have reinforcing sort of flywheel characteristics to them, productivity being a main one.
Yeah.
And the market's looking forward to those.
The New Yorker, its latest issue, is a big article about how the college essay is dead now, with the kids all using AI.
Yeah.
But they talked to one young guy, when he sends texts to girls, he gets AI to help him.
Good luck to him.
But I wonder, is it going to rot our brains, though? I mean, I've heard suggestions this is preventing people from thinking AI is doing it all for us.
We've had that kind of argument for many, many decades about technological advance and innovation. It, in my view, is a tool. It's going to make us more efficient, faster, maybe free up some brain space for us to tackle more cerebral, more difficult problems.
That's true. Things you actually need a person for.
Yeah.
Yeah. Wall Street Journal had a piece, though, saying some workers are asking, well, if I save time using AI, what does that mean? More work?
It's a bit like the work from home. I think workers, if you don't have a 2-hour commute like we have in this town, I think they were prepared to share some of that with the organization and share some of that with their personal life and their family, and that seemed fair. AI might be a bit of a similar story.
That's interesting, a compromise, yeah. So you have a slight equity bias right now, but you're not pounding the table on stocks, it sounds like.
It depends on your time horizon. I am a bit concerned where we've gotten to very quickly. We've got a number of hurdles to get through now through the end of September. Certainly the tariff piece is one, but there's some liquidity issues as well with the Treasury General account in the US and things of that nature, a little bit technical. Bond yields are elevated, and so that should cause a bit of crimp to valuations. We're not seeing it just yet. Beyond that, though, if we start to think about the market in October, November, looking into 2026, and we start to see earnings growth that is back into these low double digits, 9, 10, 11% range, then there's upside from here for sure.
I suppose, well, it's always the guidance that investors pay attention to. And if we get lots of dire warnings on tariffs in the next few weeks, that won't be great. Yeah,
there's excitement right now. S&P 500 earnings just starting out, beating by 9%. But it's been largely financials and things that are not particularly tariff impact. FedEx was in there, and they did well. So there was one. You're right. We're going to get the consumer packaging and the consumer goods and all that coming down the pipe in the next number of weeks.